So I'm about to show you the most simplest video that you have ever seen on market structure. It's going to be that simple. You're going to be left wondering, what the hell? I'm actually confused because that's how simple it actually is. Now, I've been obviously trading for a long time now, since 2016, and I've been using this way. I created my own way to map out structure just to really simplify the whole process because, well, I used to trade it quite traditional in the sense that, I've still left wondering where the highest point is or where the lowest point is within the market. But this way, it's a rule-based approach. It's very simple to follow, and we're just going to be simply going over market structure. Now, first things first, why should you listen to me? Well, this is my payout invoices from Rise that you can see here, back-to-back consistent monthly payouts, right? Not also that, this is my current journal so far. So we're currently on the 9th of February, and obviously started trading the February 2nd. I'm already up 8.65R. February, as you can see here, I closed out, January with 31.79, and also on the left here, I've just got funded as well. I'm also funded with Go Funded Trader as well, so that's another firm. And also, as you can see from here, within 46 trading days from October to December, well, October 7th to December 9th, I did a challenge and I ended up with 57.7R. So, I've got a little bit of knowledge, and obviously the way I trade seems to be working so far. And I've been trading this way for many years, but that's exactly why I want to do this video, because I want to show you guys the simplest way to map out market structure, because trading doesn't need to be overcomplicated. You don't need to look for certain things, in order to have your high or your low there. Just keep it simple, keep it rule based, and things will click into place. So first things first, obviously, we're going to go up, do the textbook version, I guess you could say, before we jump onto the real live market. And simply all we're going to be looking for is 3 candles. Okay, that's literally it. 3 candles, vice versa. We'll do the same as well for the range low, but for now, let's just map out as if what we would have as a range high, which should be like this. Okay, so obviously, you've got the wicks here. Excuse my drawing. I'm not the best trading view drawer, as you can see. But, if we just go ahead and, for visual purposes, make it make sense. Okay. So as you can see here, what do you have within a candlestick? Well, obviously you have the wick, and obviously you have the body surrounding that. Okay. And obviously the basics, when you have a bullish candle, price opens lower and closes higher. Okay. Vice versa, bearish candle, when you got the wick and body, but also price closes, opens and then closes lower. Okay. That's exactly what a, bullish candlestick and a bearish candlestick is. We all know that. This is not going absolutely over the basics in terms of trading video. If you want to learn the basics and you need trading, I have a free course for you guys to go ahead and check out, which can be linked below. So make sure you go ahead and check that out, and it'll show you more about the way that I trade along with my entry models, and you'll just get a bit of a deeper insight into a 7-figure funded trader. Now, as you can see here, right, this is a range high. Now, the reason for this being a range high is very simple. Why? Is because this wick high is higher than the candle wick and the candle wick to the right of it. Okay, so as you can see, in terms of pricing, obviously, for visual purposes, well, let's just say that this is priced at 1 and 1, and this is priced at 2. Okay, and let's say 3, 4, 5, 6, 7, etc. is all the way up there. But as you can see, this candle wick is obviously higher than the one to the left of it and the one to the right of it. So that's all it consists of. It's 3 candles. And obviously for the range high, you're looking for that middle candle wick to be higher than the one to the left and right of it. It doesn't necessarily matter too much about the body, but it just must be higher than the candle to the left and right of it. And that would be our range high. Okay. Now, if we were to go ahead and do this for a range low, and let's just extend this lower for visual purposes. Like I said, I'll go into the live charts for you in a second. You can clearly see that here. Let's just go ahead and take it one extra step further. So we have a bit of a range low there. Okay. So as you can see from here, we have this bearish candle, okay, whatever, bearish candle. We have a bullish candle, okay, we get a range high. It doesn't matter, it can also be a bearish candle. This could be a bearish candle and still the wick would be higher, and that would still be a valid range high, okay. Like I said, I'll jump onto the charts and show you more of a live market, perspective in a minute, but just bear with me for now. But as you can see from here, this is a range high. Why? Because it engulfs the candle to the left and right of it. I'm not looking for it to engulf 3 or 2 or 5 candles to the left of it. It's just literally 1 candle to the left and right of it, and that is it, okay. And as you can see from there, well, we break structure. This is also a low. Why? Because obviously the candle to the left of it, to the right of it, in terms of price points, this wick low is obviously significantly, or well, not significantly lower, but it's lower, okay, to the candle to the left and right of it. And as you can see from there, we put in a low, we put in a high, okay, price has now formed a high, we then put in a new low, but the low is still yet to form. This is not a low just yet because obviously we need the right candle next to it to close before confirming this is the low. Because let's say price opened here, went higher, you can anticipate that to be a low, but obviously it's more confirmation when that candle next closes and obviously opens with a new one, okay. And as you can see from here, we broke structure, so now we're obviously heading into a potential bearish market. Therefore we're going to go ahead and find out the low. Why is this a low? Because the candle to the left of it and the candle to the right of it is obviously higher than obviously this candle wick low, okay, and this must close to be higher probability. Now obviously, as always, the rule of mapping structure, the rule of thumb is to always follow price backwards. So when you've marked out a low, go backwards to locate the high, which would be here. When you marked out the high, okay, like here, always go backwards to find out the low, okay. Sometimes you will get a one candle range, which is pretty rare, but it's still obviously, you know, visible sometimes. But yeah, that's kind of like the range low, range high, range low, etc. That's kind of the principles behind it. So with that being said, I don't think there should be any questions at this point, unless we obviously get onto the live charts, and maybe there is, okay. Now when it comes onto the charts, you don't want to necessarily just start off from here and here, okay, because obviously this candle's still forming. You can, again, like I said, anticipate that to be the range high depending on certain conditions, but I'm not going to go over and break down my strategy because there's no point, okay. The way that I trade, obviously this ties in very nicely to the way I trade, so if you want to learn a way more on how I trade, like I said, free course below, go ahead and check it out, or just check out some of my other videos as well, and you can get an insight into the way I trade. It may be similar to other concepts like liquidity, POIs, market structure, etc., but like I said, the way that I approach things is very, very different. And it's actually very simple once you truly understand it, okay. And obviously I trade within specific conditions as well. Now as you can see from here, like I said, you don't want to just go into the chart randomly and mark up a high and low. Like, yes, in this case this is the high and low, or well, the high is still yet to be confirmed, but currently speaking right now this is the highest point within that range, but the low is already confirmed, and you know, technically speaking, that this is valid. But you don't always do that, because if you're sometimes too zoomed in, you know, and you've got this low and this potential high formed here, if you're not looking to the left, like, even though this is bullish right now, right, so that would mean like, yeah, you're looking for a pullback, continue, you know, potential bullish price action depending on obviously higher time frame, multi time frame alignment, etc., analysis, right. But the way I'm trying to say is, like, if you're too zoomed in on the current bit of price action, which is okay at times, you're sometimes going to be, you know, missing out on a bigger picture to the left of it, because this could just be one big bearish range, okay. But because you're so zoomed in, you'd be looking at this as a bullish range, and then you'd be left wondering, well, why didn't my longs play out? Okay, now that doesn't specifically what I just said, you know, tie in nicely just for this, you know, time frame. Well, it can happen to any time frame. You know, you could be engulfed by a previous bigger range, is what I'm trying to say. Okay, so what you know, a rule of thumb is to just start somewhere previously to the left, and straight away I can, you know, go ahead and start up here because this is a low, this is a high, and you can see price is shifted bearish. Okay, but for this video's, you know, sake, I'm just going to start from randomly here. Okay, I'll also go down to the 15-minute time frame to show you guys, and things should start to click a little bit more. So we'll just look at it from here. Okay, so we broke structure here previously. I don't really care what's going on here because, well, I just don't. So I'm going to start from here, and as you can see, we get this new range low, we get this new range high. Okay, but first things first, why is this a range high? Why is this a range low? Again, because the candle to the left of it, candle to the right of it is obviously higher than this candle wick low. Okay, why is this a high? Well, because look at this candle and look at this candle. It's in terms of price points on the wick high, it's lower. Okay, then from there, as you can see from there, we get a nice PR mitigation and a nice sell-off. Okay, and as you can see from there, this is not a wick low at this point. Because why? Because price didn't break structure. And I don't want to, you know, I guess market breaker structure comes into market structure, etc. But just a rule of thumb, I didn't really disclose all that. But I use candle body breaks on 15-minute, 4-hour, daily, and weekly. I don't use any other time frames except these time frames up here. The 1 minute I do allow and use wicks. Okay, but because we're on a 4-hour time frame, this here is not a break. I'd look at this as something different. And I'm not going to explain why and what I view this as currently speaking, but if you want to learn more, free course below. Okay, but as you can see, this is not a clear break just yet, so technically we're still inside of this bearish range. However, this candle comes, and as you can see, we obviously close below there. So now we have this low, and now we have this high. Okay, as you can see, there's no reaction off any POI. Instead, we just flip bullish. Why? Because price is now closed with this candle here ever so slightly, and now we're going to wait for the range high to form. And we can go ahead and mark out the range low because, well, that's already formed because this candle is now closed. And as you can see, what do we see here? We get this range high. Why? Because this candle and this candle is obviously lower than this. Okay, now again, like I said earlier, this is quite important to wait for that right candle to form or to close, but you can get away with anticipating it to be like a certain low and high. Okay, now this can get a little bit trickier because obviously at this point, you know, you'd anticipate this is a high. Okay, it may look quite equal, but if you zoom in to be like, you know, if you really want to zoom in and look at it, you can see that it's obviously higher. Okay, so I just kind of missed that, but in terms of price breaking structure, it didn't break until here, so that's why I've gone for that one, if that makes sense. Okay, now from there, what do? Well, you follow price backwards, so now you've got this range high and you have this range low. Okay, I wouldn't refer to this as my range low, and like I said earlier, it can sometimes happen in one candle, you know, ranges, but it's very rare that it does. Anyways, well, pretty much what we'd be looking for here is if we had a bullish bias and we were looking to long, obviously we need to see price close and stay above this range low. If it comes and closes below this low, then obviously we'll be entering into a bearish market. So long as this candle, etc., is staying below, or sorry, above this range low, then that's all that matters and aligns with our bullish bias. Anyways, as you can see from here, we break structure again. We then form a new high here and then form a new low here. Okay, again, we get a nice PR mitigation there, but I'm not going to break down the strategy too much. And as you can see from there, we break structure again to the upside with a nice closure here, but the high still yet to form until we get here. Now, as you can see from there, we get a range high, range low. We then pull back. You can anticipate a pullback as well. That's part of my strategy, but again, I'm not going to discuss too much of that because, again, this video is more about breaker structure, market structure, sorry, right? And as you can see, we pull back into the POI pretty nicely and react from there. Okay. From there, this is still a range high. This is an internal high. So pretty much internal structure is everything inside of this external range high and this range low. So if you have this as your low and high, which it is the way that we trade at ZCFX, everything inside of this range is all internal structure and can sometimes be deemed as noise. Okay. And obviously the better move that we'd want to focus on would be, well, it would be this area. Or this move from here based on this mitigation, but you can use internal to potentially scale into your opportunity, positions. For example, we got a nice break in mitigation there based on this internal break. We get an internal high, internal low, price pulls back, mitigates the POI pretty nicely there and continues bullish. And then obviously we take out another internal high there, but this is the external high, and obviously external rules internal. But sometimes when you have such a big range inside of the external range, you can anticipate the internal to align with the external. Okay, and as you can see from there, what do we see? Well, we see price obviously continue bullish, and this is a very typical market open. So as you can see, Friday to Sunday, this is a market open gap, and this is actually a strategy based on its own. So gap fills upon market open. If you're up late during those times, you can usually see price obviously come back down to fill that hard time frame gap, and then obviously continue bullish, which is exactly what price did here. But going back to the market structure, this is the high again because the candle to the left and right of it is obviously lower. Okay, you're looking at those price points. That's the high. This is obviously the low, but obviously the low will be way formed before the high is still formed. Okay. From there, as you can see from there, we don't close, but we do close here. We then get this range high, again, for obvious reasons. We follow price back, we get the range low. Okay. Now instead, what do we see here? So this has all been bullish price action. Okay. This has all been bullish, this has all been bullish, this has all been bullish. And it'll actually, the way that we trade here at ZCFX, you don't necessarily have a high trade count, but it does allow you to get into more opportunities. It's just obviously that we apply certain filters and specific conditions to trade. We don't trade every single day or every session. We know when and what to trade. Anyways, as you can see from here, We then shift bearish here, not the straightest line, but it was a closure if you just look there. Very slight closure. We then get this range low, follow price back, we got a new range high. Now these are all internal mitigations, internal mitigations, internal mitigations. That's a different story, but still, you know, if you had the high time frame on your side, and that's pointing to a potential bearish bias, or at least you're expecting the short-term bounce off the potential high time frame supply area, and that's still valid to obviously, you know, opt in for internal structure, etc. Right? Anyways, from there though, we just continue bearish, you know, low, high, etc. What do we see from here? We get a break of structure. Okay, we don't really get a deep pullback, but a potential break of mitigation there, which we won't discuss. I'm not here to discuss PR mitigations. I'm here to discuss market structure. Okay, and anyways, as you can see from here, we break structure, we follow price forward. What do we see here? We get a range low, and then we follow price backwards. We have a range high. What do we see from here? Well, we map out the low, we map out the high. Price more so consolidates for a little while. We did get a nice initial mitigation here, which we did obviously run into the low, but obviously price failed to close below the low and instead wicked it. Okay, we rejected that low, then obviously continued bullish there. As you can see, we've now closed bullish. The high is still yet to form in the current live market, but we can still follow price back and form this is the low. Okay, and that's pretty much how market structure pretty much works. Now on the 50-minute time frame, it can get a little bit more cluttered the lower time frame you go, but still it's the same principle. So I'll just start off as soon as price started to reverse here, bearish wise. Okay, so as you can see from here, we'll just start off from here. So we get the range high, we get the range low. Then this looks like a fundamentally driven move as well. That probably looks like some FOMC speech at that time. And as you can see, we get a shift to the downside. Okay, we break structure here. We then get this new range low, range high. We pull back. That there is a nice short. Okay, then obviously we drop to the M1. Anyways, as you can see from there, I try not to discuss entries, but if you're my student and you know how I trade, you're probably watching this and you're probably already seeing these opportunities on your eye anyways, which is awesome. So make sure you keep looking out for those little details as it'll help keep improving. Anyways, as you can see from here, we get a closure below this low here. Okay, and nice. I won't discuss that, but if you see that, student, you know, you kind of guess the move. Anyways, range low, follow price back, got the range high, break structure again, range low, range high. Okay, we finally closed bearish here. We did obviously already pull back there, range low, range high there. Okay, we then shifted bullish, range high, range low. Okay, what do we see here? Got a break here, range high, still the same range low. That's sometimes another possibility that'll happen. You'll still sometimes get the same range low or the same range high as the previous range. It's absolutely fine. And as you can see from there, we continue bullish, range high, range low. And now this is the thing where it gets interesting. If you understand imbalances, it's commonly referred to as fair value gaps, but I refer to it as imbalances because, well, I've been trading for many, many years and I learned it as imbalances, not fair value gaps from ICT himself. I learned it from a different person and yeah, it was originally named as imbalances or inefficiencies or gaps in general, right? If you include imbalances within your range, that's fine. I personally don't all the time. It just honestly depends, but it's one of them. You know, if you were to include imbalances within your range, you'd have this range because obviously the imbalance and this would be your low and high. Okay, so if you want to do that, that's fine. If you don't trade my way, I'm not going to disclose too much information. But if you do trade my way, or if you don't trade my way and you want to test this out for yourself, be my guest. Okay, so maybe do a difference in terms of, you know, do the ranges more likely hold if it has an imbalance? Is it compared to, does it not necessarily hold as much compared to if it doesn't have an imbalance within the range? Okay, so make sure you do your own due diligence when it comes to that. Unless you're my student, I can obviously help and point you in the right direction. Anyways though, if you were to just follow with no imbalances, as you can see here, we get a shift to the downside. But, you know, these are those times where you're not trading. This is Asia session. Anyways, from there, we get a range low, we get a range high, shift back bullish. And when you start to see price chucking bullish, chucking bearish, chucking bearish, chucking bullish, whatever, that is deemed as choppier conditions. That is not a trending market. So it's always better to sit on your hands if you don't know what you're doing, sit on your hands. Okay. But I know for straight away, if you're a student of mine, you'll see this here and you'd be like, well, I could actually get a nice long position off there, right? And vice versa, a nice short position here and another short position here, you know. So if you don't know how to trade it and you're seeing chock, just sit out and wait for the clearer market conditions. Wait until you're seeing this bit of price action. Okay, when price is trending, we're pulling back, trending, pulling back. Okay, you do not need to be in the market every single day. Anyways, as you can see here, we chuck back bullish, we get a range high, range low, respect the range. Okay, what do we see from here? where we just kind of consolidate for a little while, to be honest. We shift bearish here. I actually think a couple of students caught this trade. I do just want to quickly check my January journal, because was it January 29th? Thursday, January 29th. EU. It was a short. I think it might have been this move. 8:15 around it was, okay. Yeah, so I caught this one, okay. Anyways, as you can see from here, what the price do, well, we shift bearish here, we get this new range low, new range high. We get into some more trending conditions now, okay. Nice BR mitigation. If you want to go ahead and study that, you're more than welcome to. That was my entry. And then obviously from there we close, we go to range low, range high, range low, same range high, range low, same range high. So this is what it means. Like I said, sometimes you get the same range high. As you can see, we pull back into the extreme, etc. Range low, range high. This is, I believe, a fundamentally driven move. And then from there, this is Friday as well. And then we just get a slight closure above here. This wasn't a real closure, because when you looked at the DXY chart, it just wicked it, so it didn't really confirm that move. But based on structure, it's a chalk there. And as you can see, we get a shift to the downside. We get a new low, new high, new low, new high, shift bullish, new high, range low. We shift bullish here again, range high, range low, shift bearish, range low, range high, range low, shift bearish, range low, follow price back, range high. Okay, and you can just see the pattern. It's very simple. That's all you're looking to do, and it's that simple. It can be a little bit confusing, which is fine at first. You're not supposed to get it at first. Just to let you guys know. But with re-watching this video, writing down some notes, and just thinking of the way that actually it makes sense, for example, the highest point, the lowest point, then it'll make sense. Because all you're looking for, I'll continue for now. Breaker structure, range low, okay, same range high, breaker structure, low, high, okay, low, high. Okay, we just continue bearish, we get the range low, we get the range high, break structure, range low, range high, break structure, range high, range low. What did the price do from there? Well, this is just one big consolidating market. We then shift bearish, okay, from there, range low, range high, break a structure, range low, range high, range low, range high, break structure, range low, range high, break structure bullish, range high, range low. Okay, range high here, price back, follow range low. This is also a range high as well at the time, and low. Range high, range low, range high, break structure, range high, range low, break structure downside, range low, range high. Okay, range low, range high, and that's pretty much it. Okay, I could sit here all day and go range high, range low, range high, range low, but it's just not needed. Okay, what I want you guys to do now, if you're still watching, if you're really watching, well done, give yourself a pat on the back. And I just want you guys to go onto the chart, pull up any chart, because this works across any market, by the way, any time frame. The principle still stays the same. However, like I said earlier, if you clicked up on the note, what I do on the M1, which is different to the rest of the time frames, then you'll understand what I'm talking about. If you didn't hear that, then I guess that's on you for not listening. But it does change slightly on the M1 time frame, based on how I approach breaks or structures. That's the key. Okay, but guys, if you want to learn more about this and the way that I trade, make sure you click the link below. There's a free course there. It's completely free. There's no catch to it. All I just want is your email. Just put in your email, you get sent a link, so make sure you check your spam folder and inbox, and then you'll pretty much get a link to the free course, and that's pretty much how it'll work. But any questions, make sure you pop it below us. Send me a message on Discord. If you want to become a student of mine and get real hands-on coaching, then obviously I'm right here. Link will also be there below for that, for the academy. But guys, thank you so much for watching. And remember, it's actually very simple. You're just looking at the highest point and the lowest point, and all you're comparing is the candles to the right and to the left of it. And if obviously it stands out and it's higher, like in terms of the range high, then it's a range high. Vice versa, stands out, it's lower, range low. That's pretty much it, guys. See you on the next one.